So we begin with the big issue, the Federal Reserve stuck on hold.
We think the Fed is on hold.
On hold? Off the table.
On hold for some time.
There's really no reason to raise.
Fundamentals of the U.S. economy are still really strong.
Growth looks fine, by the way, not a problem there.
Look at how strong the labor market is.
Consumer activity, confidence, wages going up.
Wages are going up.
The employment picture looks very, very robust.
You have an already tight labor market.
It's all about inflation.
Inflation.
Inflation? Inflation.
Inflation is what's on everyone's mind at the moment, and that's what everyone is focusing on.
Inflation is missing the Fed's target by 50 basis points. That's the problem.
It's come down. It's lower than they would like.
Unless and until inflation picks up, the Fed is going to become, I think, a pretty boring story from a market raising or hiking perspective for quite a while.
Joining me around the table here in New York is Megan Greene, Manulife Asset Management Chief Economist, Mark Connors, Credit Suisse Global Head of Risk Advisory, and Bob Michael, JPMorgan Asset Management Chief Investment Officer. Megan, let's begin with you. Is it going to be a snooze later?
So I think it will. This one will largely be a snooze. The only interesting thing is they might have a technical adjustment of the interest on excess reserves because the Fed funds rate, effective Fed fund rate has gone and traded through it, and that could either suggest there's a scarcity of bank reserves, or it could be a reflection of a whole bunch of technical factors. I think it's the latter, and so the Fed probably won't do anything on it, but that's potentially the most interesting thing.
Does the chairman do a good job of explaining that in the news conference?
Yeah, I think it's going to be hard to because it is so technical, but I think he'll probably skate past it and mainly focus on things like inflation, which is what everybody's looking at.
What are you looking for, Bob?
Well, there are a couple things. I'd like to see a little bit more clarity on balance sheet management, and I'd also like to know a little bit more about what the reaction function is. We, like everyone else, thinks they're on hold for the foreseeable future. What changes that?
That's the problem I have with the Federal Reserve right now. I could tell you in the commercial break a little secret. All the data points you possibly want for the economy for the next 12 months. And Mark Connors, you still can't tell me what the Fed's going to do with any accuracy whatsoever.
No.
That's the problem, isn't it?
It is, and it's one reason why I think people are not changing positioning from just long equities. We see a tactical long in the 10-year still, believe it or not, because I know people are saying cut, but we're seeing people long risk, long tenure, like in a barbell approach. Because if we're in a late stage economy with high multiples, people still want a little tail risk.
The market positioning increasingly for a rate cut, kept alive by this idea that inflation doesn't pick up. Megan, you're taking the other side of this. You're looking for a rate hike as the next move. Why?
Yeah, I think it's more likely. I actually think there could be signs that inflation might come through. I'm not looking for a late cycle surge in inflation by any stretch of the imagination, but input costs are going up for companies. As they're looking down the road, we're going to have a recession at some point. This is their only chance really to pass those costs on to the end user. So you could get some inflation, wage inflation starting to come up. It should just tick up really slowly as it has been doing, but that could justify a rate hike. And all the cross currents that Chair Powell highlighted for his capitulation to the markets, those are all going to abate by the second half of this year. In fact, already are in most cases. And so I think the economic story will look better.
I think a lot of people would agree with you as well. Do you agree with that, Bob?
No, I don't. We've had higher input costs for a while. We've had full employment, we've had wage gains going up, and what's missing is an economy strong enough for companies to pass that along through to the consumer. And instead, what companies are worried about is disruption from technology and other forms.